June, thank you. June Grasso at the NASDAQ market site. Well, next week, the U.S. government will probably sell $12 billion of 30-year bonds, and that would almost double the amount of outstanding debt in this issue and more than $28 billion. Now, credit strategists at Lehman Brothers say this may lead to a rally in longer maturity corporate debt. How? Well, Bloomberg bond reporter Carolyn Salas joins us now to explain. So, Carolyn, what about this? You've been writing about this Lehman report. What are they saying about the sale of 30-year treasuries?
Well, Lehman analysts are saying that after the auction next week, corporate bond investors will start using the new long bond, which matures in 2036, as their benchmark instead of the old long bond, which matures in 2031.
So why would they adopt the new long bond then?
Well, after the sale, Lehman is forecasting that there will be about $28 billion of the bond outstanding, as you said, and that compares with about $16 billion for the bond that matures in 2031. So their argument is that the new long bond, the 2036 bond, should be more liquid or easily tradable than the old one, so that may compel investors to switch their benchmark.
Why didn't investors adopt the 30-year treasury as the benchmark when it came back in February?
Well, at the time, the spread, the yield differential between the 2036 bond and the old bond, the 2031, was about 12 basis points, which is large enough that it would have caused more of a market disruption at the time. So a lot of investors kept the 2031 bond as their benchmark.
And explain a little bit more about how the switch is going to prompt maybe a rally in corporate.
Sure. Well, one of the reasons that has changed is that the spread has since compressed. It's about halved. It stands at about 6 basis points right now. But the way that the corporate bond market works is it's a spread market, meaning that investors look at corporate bond yields relative to treasury yields as sort of a gauge of demand for those bonds and also the market's perception of the credit risk in those bonds. So assuming that the market's view of credit risk stays the same, they're just using a benchmark that has a lower yield. So for that spread relationship to remain constant, the price of corporate bonds would have to rise, and the yield would therefore have to fall.
Yeah, how much are we seeing in terms of a gain, and how much have we seen? What kind of movement have we seen so far?
Well, in July, corporate bonds maturing in more than 15 years returned a little more than 2% to investors. That compares with about 1.5% for the typical corporate bond. So we were seeing a rally. Prices gained by about 2 cents on average during that period. So you were seeing some price action.
All right, Carolyn, I appreciate it. Thank you. And again, Carolyn